Good afternoon. I'm joined today by David WACHTER, founder and CEO of W Capital, and also a partner in AXA IM Prime, which is a part of BNP Paribas. Welcome, David. Thank you very much for joining us today. I wonder if you might please just give us a brief overview. There are a couple of roles mentioned there in the introduction. I wonder if you might just give us an overview of yourself and your firm.
Sure, thank you, and thanks for having me. W Capital Partners is a GP Solutions secondary fund. We've been in business for over 2 decades, providing liquidity and capital to GPs in need of midlife capital during the life of their assets. We do it in the form of direct secondaries and GP-led continuation funds. About 2 years ago, AXA IM Prime, the private equity division of AXA, acquired all of W Capital. So we're in a very exciting growth mode under that global platform.
Okay, fantastic. And I understand you have 2 decades worth of experience in GP-led secondaries, and it's certainly a market that we've seen growing significantly, and there's much more interest in it. Why do you think it's taking off at the moment and has had this surge in interest?
Sure, it's a very exciting market. To start with, when we started 20 years ago, secondaries were actually a sign of weakness, where only those GPs that needed liquidity were selling. It evolved, and over the last 10 years, it's now a strong sign of strength within the GP community. So those assets that have a secondary market are better quality and showing strength for the GP. So it's created and opened up this incredible opportunity to offer liquidity during the journey of a private capital company. In addition, the number of assets in private equity have grown from 7,000 to 29,000. But the number of exits has not grown at all. So what we have now is a large universe of well-performing private equity-backed businesses, but they aren't selling because there's only about 1,500 exits a year. So with the growth in the market compared to the flat line of exits, there's now 20 years of asset overhang relative to exits in the private equity industry, making direct secondaries so exciting.
Okay, really interesting. And you touched on it in your introduction as well, but continuation vehicles, we've seen headlines, some skepticism in some parts of the press. What's your perspective on the current trend in CVs and the growing popularity of them?
Great. So CVs are the sale of a portfolio company into a new SPV with fees and carry. And that's an opportunity for a fund to exit the asset and new investors to invest while the GP keeps control of the investment. The controversial part is that a fund is exiting the company. When should a fund exit its trophy asset? And is that actually good for the flagship fund or not? And given that the GP is both the buyer and the seller, there's quite a few conflicts of interest there. So there's a lot more attention being placed on whether an asset is appropriate for a CV, and really the GP thinking harder than before about whether the sale of that asset from the flagship fund is the right strategic decision for the original LPs or not. And at the end of the day, the original LPs funded 5, 6, 7, or 8 years of fees and invested in a blind pool. And what is the ideal time and the appropriate time for the GP to choose to exit that asset from the flagship fund? So it's quite complicated. But if you think about last year, there were only 70 CVs that closed. So there's 29,000 assets in private equity. So the attention on that part of the market is enormous, but really it's only a small part of the liquidity solution in today's private equity market.
Makes sense, thank you. And just to go back to GP-led secondaries, we've seen new market entrants, maybe perhaps a bit more competition. How are you seeing that play out? Is that something that's impacting you, or do you think that that's a good thing generally for the growth of the market?
So what we have is the original secondaries buyers that do LP stakes now buying CVs, continuation funds in the form of GP-leds. We have a lot of primary buyout funds entering the GP-led market. Those primary buyout funds see an opportunity to be a buyer and an investor in trophy assets. Our question is buyout funds providing a liquidity solution to their buyout fund peers? There's a little bit of question on whether a buyout fund should be the liquidity provider and the capital provider to other buyout funds. So the CV market is being supported by a lot of these new entrants. We believe that being an asset manager is a more arm's length and value-added solution provider to the private equity GPs.
Great. And final question for you. We've obviously had quite a constrained liquidity environment over the last few years. What's your view on what happens when some of that liquidity starts to come back to the market, and what will the knock-on effect be, if any, on GP-leds and CVs and this market generally?
Great question. So over the last 20 years, there's actually been an incredibly steady dollar amount of exit volume. Other than 2021, there's 400 to 450 billion of PE exit dollars generated per year. So while we all see a market where we believe that the markets will come back, it's actually a very healthy and consistent exit market today. So in fact, we are not in a depressed exit environment. What we're in is a market where the denominator has tripled in size, even though the numerator is not compressed at all. So we've reached a point in time where historically, realizations relative to NAV has been about 20 to 22%, where today, not because of realization value, but because of NAV, it's down to 9%. So we are at a record low of distributions relative to industry size, but not because of an unhealthy exit market. It's just because of so many assets being owned by private equity.
Well, thank you so much, David. That was really, really interesting, and thank you for coming on today.
Thank you for having me.